Taxes. The mere mention of the word is enough to send a shiver down the spine of any hard-working American. It's no secret that watching a substantial portion of your income disappear into the government's coffers each month can be a bitter pill to swallow. But what if I told you that there are legitimate, IRS-sanctioned methods you can use to keep more of your money working for you and your family instead of the government? In this video, we're going to explore 10 powerful yet little-known strategies that can help you legally slash your tax bill and take home more of your hard-earned cash. And no, I'm not talking about shady offshore accounts or questionable loopholes that only work for the ultra-wealthy. These are practical, accessible solutions that you and I can implement starting today. So keep watching. After COVID-19, working professionals in America either work from home completely or travel to their workplace every single day. If you're one of the millions of Americans working from home, your home office could be a major source of tax savings. Enter home office deductions. Before you start deducting a portion of your mortgage and utility bills, there are a few things you need to know. First, your home office must be used exclusively and regularly for business purposes. That means your kitchen table doesn't count, even if you use it to answer emails in the morning. Instead, you'll need a dedicated space that's used solely for work. Assuming you meet that criteria, there are two ways to calculate your deduction: the simplified method and the regular method. Under the simplified method, you can deduct $5 per square foot of your home office, up to a maximum of 300 square feet. It's a quick and easy way to claim the deduction without having to track individual expenses. If you want to potentially claim a larger deduction, the regular method allows you to deduct a portion of your actual expenses, including mortgage interest, property taxes, insurance, utilities, and depreciation. The catch is that you'll need to keep detailed records and allocate the expenses based on the percentage of your home used for business. Whichever method you choose, the key is to be proactive and consistent. Keep a log of the hours you spend working in your home office, and hold on to receipts and bills for any expenses you plan to deduct. And if you're unsure whether you qualify or which method to use, don't hesitate to consult with a tax professional. 2. Commuter benefits. Unlike in the first case, if you travel to work every day, then the commuter benefits is for you. If your employer offers this perk, you can set aside up to $300 per month tax-free for qualified transportation expenses. That means whether you're driving, carpooling, or hopping on the subway, you could be saving thousands on your taxes each year. And the best part? It's money you would have spent anyway just to get to work. Why not let the IRS foot some of the bill? To take advantage of this strategy, start by talking to your HR department or benefits administrator. They can walk you through the process of enrolling in your company's commuter benefits program and help you determine which expenses are eligible. Just remember, the key is to plan and set aside the money before you incur the expenses. 3. Retirement plans. When it comes to saving for retirement, 401k and 403b are the heavy hitters of the tax-saving world. By contributing a portion of your paycheck before taxes are taken out, you're not only building a nest egg for the future, you're also reducing your taxable income in the present. But here's the thing. Many people aren't maximizing their contributions. In fact, the average 401k contribution rate is just 7% of an employee's salary. If you're not hitting the annual max of $19,500 or $26,000 if you're over 50, you're leaving money on the table, both in terms of retirement savings and tax breaks. So how can you make the most of this strategy? Start by assessing your budget and determining how much you can realistically afford to contribute each month. If your employer offers a match, aim to contribute at least enough to take full advantage of that free money. And if you get a raise or bonus, consider bumping up your contribution percentage before lifestyle inflation sets in. Hope you found these 3 strategies helpful. These are simple, basic, and easy to implement. The next 7 are a bit complex but can save you more money than what we've discussed so far. They require greater attention to understand and are serious money savers, especially the 7th and 8th ones. So if you've zoned out during any part of the video, come back later to complete watching. 4. Health savings accounts, HSAs. If you're enrolled in a high-deductible health plan, an HSA can be an incredibly powerful tool for saving on taxes and healthcare expenses. But what exactly makes them so special? First, contributions to your HSA are made with pre-tax dollars, reducing your taxable income for the year. Second, any interest or investment earnings grow tax-free within the account. And third, withdrawals for qualified medical expenses are completely tax-free. It's like a supercharged version of a traditional savings account, but with serious tax benefits. To make the most of this strategy, aim to max out your HSA contributions each year. For 2024, that means contributing up to $3,650 for an individual or $7,300 for a family. And if you're able to pay for medical expenses out of pocket, consider leaving the money in your HSA to grow over time. That way, you'll have a dedicated fund for healthcare costs in retirement when you're likely to need it most. 5. Charitable donations. Good for the soul, good for your taxes. Giving back to your community isn't just a feel-good activity. It can also be a smart tax move. But to claim the deduction, you'll need to make sure you're following the rules. First and foremost, you'll need to itemize your deductions using Schedule A. That means forgoing the standard deduction and instead listing out each individual deduction, including your charitable contributions. Keep in mind that under the current tax law, you'll need total itemized deductions to exceed $12,950 for single filers or $25,900 for married couples filing jointly to make it worth your while. Assuming you do itemize, you'll also need to keep detailed records of your donations. For cash contributions, that means holding on to receipts, bank statements, or acknowledgement letters from the charity. And if you're donating appreciated assets like stocks or real estate, you'll need to obtain a qualified appraisal to substantiate the value. One often overlooked strategy is the donor-advised fund. By making a large contribution to a DAF, you can claim the tax deduction in the year of the contribution, but then distribute the funds to your favorite charities over time. It's a way to bunch your donations and maximize your deduction, even if you plan to give smaller amounts to multiple organizations. 6. Capital gains tax strategies. Now, if you do not know what capital gains are and how you can use them to your advantage, let me explain them quickly. In simple terms, a capital gain is the profit you make when you sell an investment. If you buy a stock for $10 and sell it for $15, you have a capital gain of $5. And depending on how long you held the investment, that gain may be subject to different tax rates. If you hold an investment for 1 year or less before selling, any profits are considered short-term capital gains and are taxed at your ordinary income tax rate. But if you hold the investment for more than a year, those profits become long-term capital gains and are taxed at a lower rate, either 0%, 15%, or 20%, depending on your income level. So how can you use this to your advantage? One strategy is to be intentional about when you sell your investments. If you're considering selling a stock that has appreciated significantly, try to wait until you've held it for more than a year to take advantage of the lower long-term capital gains rate. And if you're faced with a losing investment, consider selling it before the end of the year to offset any capital gains and reduce your overall tax liability. 7. Education tax credits. If you or your dependents are pursuing higher education, there are 2 key tax credits that can help offset the cost: the American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit, LLC. The AOTC is available for the first 4 years of undergraduate education and can provide a credit of up to $2,500 per eligible student. To qualify, the student must be enrolled at least half-time and be pursuing a degree or recognized educational credential. The credit is also partially refundable, meaning you may be able to receive money back even if you don't owe any taxes. The LLC, on the other hand, is available for any level of higher education, including graduate school and professional courses. The credit is worth up to $2,000 per tax return and can be claimed for an unlimited number of years. However, it is non-refundable, meaning it can only reduce your tax liability to zero. To claim either credit, you'll need to fill out Form 8863 and attach it to your tax return. You'll also need to have a Form 1098-T from the educational institution, which reports the amount of tuition and fees paid during the year. One thing to keep in mind is that you can't claim both credits for the same student in the same year. If you're eligible for both, it's generally more advantageous to claim the OTC first, since it has a higher maximum credit and is partially refundable. And if you're claiming the credit for multiple students, be sure to keep detailed records of each student's expenses and enrollment status. 8. Maximizing your deductions. Throughout this video, we've touched on a number of key deductions that can help reduce your taxable income. But what exactly is a deduction, and how do you make sure you're claiming everything you're entitled to? In essence, a deduction is an expense that the IRS allows you to subtract from your taxable income. By lowering your taxable income, deductions can help reduce your overall tax liability and potentially bump you into a lower tax bracket. There are 2 main types of deductions: the standard deduction and itemized deductions. The standard deduction is a fixed amount that you can claim based on your filing status, while itemized deductions are a list of specific expenses that you can claim if they exceed the standard deduction. For the 2024 tax year, the standard deduction is $13,850 for single filers and $27,700 for married couples filing jointly. If your total itemized deductions are less than those amounts, it generally makes sense to take the standard deduction instead. But what if you do choose to itemize? Some of the most common itemized deductions include mortgage interest, state and local taxes, up to $10,000, charitable donations, medical expenses, if they exceed 7.5% of your adjusted gross income, gambling losses, up to the amount of gambling winnings reported. To claim these deductions, you'll need to keep detailed records throughout the year. That means holding on to receipts, bank statements, and other documentation that substantiates your expenses. You'll also need to fill out Schedule